Welcome to Full Speed Ahead. I'm Craig Fuller here with Mark Scudder, the CEO of Scudder Law Firm out of Lincoln, Nebraska. Scudder, Mark, how are you?
Hey, doing great, Craig. Good to see you again.
Likewise. So Scudder is a storied firm involved in a lot of the transactions that take place around the freight and logistics industry. You guys take a lot of companies public. You do a lot of private equity and debt transactions. What got you started in specializing in transportation logistics specifically?
You know, Craig, it's kind of in a way, a tale of two families. If you go back to your grandfather and my father in the 1960s, they got together and started, building trucking companies. And my dad handled the legal side, and really for a lot of trucking companies throughout the 60s and 70s. And then when deregulation came in the 80s, he was handling the M&A side and the capital raising side for folks like the Fuller family, the Moises, the Jardines, a lot of the families that were big around trucking. And as they grew and needed capital, we started doing public offerings and then helping them acquire other companies and in other ways help them grow. And that then led to working with private equity firms and other founders to get their companies going. And it's been a great industry for us, a lot of great relationships, and something we've been really happy to be proud of, or proud to be part of for those companies' growth.
Now, if you go back to the 1960s and look at things today, things have changed quite a bit. We had deregulation that took place in middle of that, as well as sort of the evolution of the third-party logistics company. I imagine that your customer list, or the folks that work with you guys, has evolved over time.
It has, and it's both evolved internally, where a lot of the trucking companies have developed their own logistics arms, and externally. And we've been fortunate to do business with people like an XPO or a Panther Expedited, or some of the other logistics companies that were part of a company called FreightWaves portfolio. And then on the warehousing side and dedicated side with the Land Air, with Saddle Creek, with a number of different companies that are involved across the spectrum, and then with TFI International, the Canadian company. We were part of closing a transaction for them yesterday, where they acquired the RRD logistics business in the United States.
Yeah, TFI has had a really great run over the last couple of years, actually the last couple of decades, but certainly the last couple of years, as they've been very acquisitive and seem to have done a really good job of ingesting those businesses and integrating them. I imagine there's a playbook for that. You've seen it with Knight Swift and what they've done with Swift and sort of the integration of the two companies there. In terms of the process of integrating those businesses, where do you think companies have the best chance of success, and where do they tend to get it wrong?
Yeah, I think the companies that have really done it right, they first of all understand a lot about the company that they're thinking about acquiring. What's the quality of the management team? What's the quality of the strategy? Is it sustainable? And then they'll play off of, if it's really not a company that is capable of performing at a level that returns the cost of capital, then you need to do something different, which generally means integrating it directly into the acquiring company, lowering cost, improving the marketing methods, doing the other things that the really successful companies do. If you have a good team of people that are capable of executing, and maybe they need a little help with capital structure, or they're really great operators, but their marketing side could use some muscle, and or maybe they're really great at sales, but they need some help on cost. And you think about a company like a Knight, with what they did with first Bar None, and then Abilene, and then with Swift, they were able to take teams that were executing really well in a lot of ways, and then bring some additional processes and philosophies to the table, and really make something that was better afterwards. And that's worked well for companies like that. And TFI has done a terrific job as well. They're very metric driven. They're very financially savvy, very cash flow driven. and they bring that kind of analytical ability and discipline to the companies that they acquire.
And Mark, you've done quite a bit of the IPOs, probably most of the major IPOs in the truckload space. I imagine that things have changed since Sarbanes-Oxley over the last 20 years. You think about companies wanting to go public. Are you getting a lot of firms that inquire about going public, or is it just an option that doesn't seem ideal for them at this stage?
Yeah, I think it's great for companies that have the right the right characteristics for being a good public company. You have to be financially disciplined. You have to have very good processes and systems. You have to have a commitment to this sort of governance profile that public investors want now. You have to have something, if you think about why do investors want to put their capital with a public company, it's because you either have the ability to outgrow the market so you can return a better result that way, or you have a very strong discounted cash flow profile so that investors can predict in the future that there will be a growth of earnings and cash flow over time that they want to be part of. And if you really don't have a superior growth model or a superior cash flow model, it's pretty tough to justify going public unless you're really using it as maybe it's a liquidity event for a founder or for another investor, and then maybe a stage toward getting acquired eventually.
Yeah, it's being in technology, you see continuous growth. Certainly our charter expectation by our investors is continue to grow, whereas you own assets, growth comes at a pretty significant cost in terms of having to acquire debt and assets that have high depreciation. I imagine for truckload carriers it's tough, but a lot of action is happening in the third-party logistics space, mostly from private equity. How are you seeing that market evolve?
That market has been hot for a long time now, and for the reason that you talk about, the cash flow characteristics are strong. Private equity investors can put enough leverage on the business and still have cash to grow. And then there has been enough interest that they always have an exit through, either selling to the next private equity firm, getting acquired by a strategic, or potentially going public. So. It's a field with a number of different options, and with you don't have to have leverage to grow the business and to pay down the acquisition or investment debt. So for those reasons, it's pretty attractive. And your observation about assets is pretty well taken. I think about a company, Genesee in Wyoming. It's in the railroad space, but I was on the board for 16 years. Company grew from about $250 million of revenue to $2 billion of revenue during that time, and the market cap expanded by about 10 times, largely through acquisition. It's a kind of a GDP grower, maybe a little bit in excess of GDP, if you can pick up a few customers here and there. But through acquisition, then pay down of debt, then acquisition, then pay down of debt, you can make an asset-based company grow. And Knight-Swift was very much the same way. But unless you can operate, in a 15 or 20% profit margin, it's pretty tough to grow an asset-based business at a double-digit rate and create the returns your investor want, unless you can also acquire.
Yeah, it's difficult. I think railroads have an advantage of not having to, particularly ones that are hauling commodities, where they have sort of an oligopoly or a monopoly of that market. They have a lot of sort of instinct advantage that doesn't exist in truckload, where it's sort of a commoditized environment where price has a lot to do with the profitability of the company. In terms of evolutions of the market, over the last 5 years, we've seen a lot of venture capital enter the market and aggressively start to make investments in not only technology companies, but also digitally enabled freight brokers. We've seen it with Convoy, Uber Freight, Transfix, et cetera. Are you seeing any deal flow in that? Do you guys participate in the early stage companies?
Yeah, we have. Most recently, we've worked with with a larger company that acquired a digital brokerage firm. It's not been publicly announced, so I can't talk about which one it is. But it was something they wanted to do to augment their call it legacy brokerage business, and be able to add on digital, and then eventually use the cost savings to drive growth.
Now, is it just versus building it in-house? A lot of times, people in the market accuse digital brokers of being a broker with an app, but is there something more fundamental and attractive about the digital brokerage space to a large legacy incumbent?
I think you've got different markets. There will probably be for quite some time the legacy model where there's a lot of personalized information about the customer that's known, the personal relationships with the carriers to be able to know exactly what they want and match them up effectively. There's also a lot of freight, and probably you'd call it more. Maybe not quite as as hot a freight, or not quite as specialized a freight, that can be matched up and digitally. And if you maybe it's an example of one, but a company that their digital system can match 47 loads per in-person broker. And the in-person broker can match about 6 per day. And so if you're talking about matching 47 loads versus 6 in a day, that's a pretty big difference in terms of revenue that you could drive over a largely fixed cost model. So I think from that perspective, you're going to see digital brokerage continue to grow. I think that you'll see the automation of a number of functions, even in the legacy models, to be able to leverage the human talent that's inside those companies. And you're going to see that the people get pushed more into sales and relationship roles, probably, than just the actual matching of the loads. If you think about it, you referred to deregulation and some of the changes earlier. For about the first 30 years after deregulation, the truckload business really took market share away from less than truckload and other modes, because they could offer cost savings and efficiency that the other modes couldn't. That the cost savings really stagnated some over the last decade, and not to say that they got worse, but the ability to drive down cost as a percentage of the shipper's wallet kind of stagnated. And if what's the next frontier for the shipper? It's really to take empty miles out of the total, U.S. shipping system. If you're still at 10 to 20% empty miles, if you can drive that out, that's cost that the shippers don't have to bear, and they're going to look for that. And digital brokers can be part of that solution. Trucking companies can be part of that solution. Technology can be part of that solution, and then using the very scarce resource of drivers is part of that solution, where they're spending more of their time driving and less of their time waiting and doing other non-productive things. So, and then you'll find specialists that get into the last mile, or other parts of the business that don't take a CDL, and those can probably be enhanced through technology as well, to really parse what can be best performed by each asset that's at a company's disposal.
Yeah, it's interesting. There's been a lot of conversation about "quote unquote" race to the bottom in brokerage margins, where the 18% of yesterday or a couple of years ago is, the sort of the top end of the margins are 15%, and now I think they're in around 13%. I imagine that technology is driving that, but it's also helping a lot of the freight brokerages that are out there compete in a lower margin market. I imagine that if you are a freight broker, you almost have to invest in these workflow solutions, as you mentioned, to do more volume just to keep up.
It's only a personal opinion. It doesn't mean it's right, but I think that you'll see overall brokerage margins probably drop into single digits over the next 5 or 6 years. and that'll still be a little barbell weighted. You'll get the digital brokerages, I think, on their percentage of freight will get even skinnier than that because they'll be able to drive cost out and apply huge volume over their platform. And I think you'll still get the more specialized brokerages that really handle the hot freight or the specialized freight, or that have established relationships with companies and they can hang on. Will continue to have double-digit margins, and you'll see some amount of differentiation between those two markets.
Mark, you talked to a lot of...
It's an opinion, doesn't mean it's right.
You talked to a lot of executives in what we would describe as sort of legacy or established very large companies that trade at very different multiples than what you see in the private venture markets, just the way that those things are priced. When you talk to these large company executives and they're talking about sort of the valuation metrics of early stage companies, what is their usual feedback? Are they just confused by it or intrigued by it? How do they think of their own businesses in that vein?
Yeah, so I think that it runs the gamut. There's some people who don't understand it and don't really think that it's relevant, and their business model is to try to work on margin and generate more with the assets they have and to continue their growth model, and so they're not as interested. There are some that look at it, I think, mainly like, what would be the cost for me to build that particular technology or application if I had to hire the people to do it internally, and what could I do with it? And they value it more based on what the company could do for them, and what's the substitution for acquiring that company or investing in that company and using the product, versus doing it themselves. I don't think most of the legacy businesses look at it like the company itself will forever be based on a multiple of revenue if it never generates profits, and so they don't really look at it like, hey, if I acquire enough of those, then suddenly my legacy company is going to trade based on a multiple of revenue.
Yeah, you have to exit at some point, and exits, valuations in early stage companies become quite different when there's an exit. And frankly, for a founder, that's really the only one that matters because you're not seeing that capital. You see it help you build your business, but investors eat first. So it's certainly interesting. I face it firsthand because being a part of a legacy family that's publicly listed and having a private company that's valued by venture standards is a big difference in terms of how those things are approached and thought of.
Yeah, and they can change quickly. You can see that in both markets, really. The public market can change quickly, but the private venture market can change quickly as well. And I think that's one of the reasons that you've probably seen a number of the SPAC transactions in the last year and a half. Is growth has been valued above value stocks. There have been a number of transactions in the technology or technology-linked arena that have been valued quite highly. It takes a long time or relatively long time to do an IPO, particularly if you're not a company with a really long established track record. And so I think some investors have decided that they're going to take money off the table and take risk off the table by getting to the market quicker, even if they have to give up a little more in terms of dilution than they might have under a traditional IPO methodology.
I'm glad you mentioned SPACs. I wonder if this is a short-term element in markets or something, a more permanent fixture. What is your take of the SPAC market? Is this a great new asset that we're going to see become sort of mainstream, or is it going to fade out as fast as it came about?
I think they've got similar products have gone in cycles. So you go back to whether they were called public shells or blank check companies or SPACs. It's similar in a number of respects. I think the things that have changed, one is the size of the investors and for lack of a better word, pedigree of the investors that are putting the SPACs together now, has really brought a different level of probably in credibility with other investors to the SPAC market. Some of the procedures that have been put in place for shareholder votes and the ability to withdraw capital if they don't like the transaction that's being proposed by the SPAC, I think have helped as well. And so no, I think it's, while I believe there will be cycles, just like there are cycles for IPOs, there are cycles for valuations in the different markets. So if you look at the last 18 months, I think SPACs have been 25 or 30% of the capital raised. Do I always think they're going to be that much? Probably not. Probably go in cycles with the IPO market and with overall valuations and interest in growth companies, where the growth company gets an exit in a way that's not always available to them, and the SPAC gets access to a company they might not otherwise be able to acquire.
Yeah, it's going to be interesting to watch how the next couple of years work out. But the great thing is there's always evolution in the financial markets. Well, Mark, thank you so much for coming on Full Speed Ahead and being a part of this great series. How can folks reach out if they're interested in talking to you about whether they're early stage and wanting some guidance on how to form their company and build their business in terms of legal advice, or potentially looking at a transaction? How can they reach you guys?
Sure. Well, thanks, Greg. They can go to scudderlaw.com. They could put Scudder and Lincoln, Nebraska in their Google and probably not get a wrong hit. And or you can call me on my cell phone, 402-499-3221, like you do. So.
Well, Mark, that's a dangerous thing to put it out. There will be a lot of people. We actually have a pretty large audience, believe it or not. So who knows who you'll hear from. But I appreciate your time today, Mark. Best of luck as we finish out the year, and I think it's going to be a good one.